In early 2026, the crypto market just got slammed by one of its most brutal crashes ever. It left pretty much everyone wondering, what on earth just happened? Well, in this explainer, we're going to untangle that perfect storm of events that sent Bitcoin and Ethereum into an absolute free fall. To really understand the crash, we have to remember the high. And I know it feels like a lifetime ago, but just a few months before everything collapsed, back in October 2025, Bitcoin was trading at this incredible all-time high of over $126,000. The market was completely euphoric. And then, this. A just brutal, relentless decline. From that peak, Bitcoin plunged roughly 40%. And this wasn't some slow bleed, no. This was a fast and furious drop that wiped out months and months of gains and completely erased that post-election rally. Which, of course, brings us to the big question. Was this because of one single thing? Or was it, something a lot more complex? Well, all the evidence points to a perfect storm, a convergence of three powerful forces that hit the market all at once. So let's break it down. We're going to look at each of these storms one by one to see exactly how this massive crash really unfolded. First up is the big picture. See, crypto doesn't exist in a vacuum. The first storm was a global economic one. As these major headwinds started blowing against risk assets, well, everywhere. Okay, this right here tells a huge part of the story. In January 2026, the Federal Reserve decided to pause its rate-cutting trend, keeping that benchmark rate pretty high. And with inflation still hanging around at 2.7%, way above their 2% target, the era of easy money was clearly on hold. So what does that do? It creates this classic risk-off environment. I mean, think about it. When investors can get a decent, safe return from something like bonds, the appeal of a highly speculative asset like crypto starts to fade. And that's what happened. Capital began to flee. And here's a key point. Crypto wasn't suffering alone, not at all. The sell-off was directly tied to a big downturn in the tech sector. You see, crypto is often seen as the ultimate risk-on tech play. So when investors started questioning those sky-high valuations of AI companies, all that fear and uncertainty spilled right over into the crypto markets. Now let's get to the second major factor, a geopolitical shockwave that put one of crypto's most important narratives to the ultimate test. So in early 2026, tensions between the US and Iran escalated dramatically, and it rattled global markets. As the threat of a wider conflict grew, investors did what they always do in times of extreme uncertainty. They ran for safety. And this is where that whole digital gold theory just completely fell apart. I mean, for years, proponents claimed Bitcoin would act like gold, a safe haven in a crisis. But the exact opposite happened. As capital flooded into actual physical gold, it fled from Bitcoin. It proved that when true global fear takes hold, capital seeks assets with centuries of history as a store of value, not assets that are correlated with the Nasdaq. Okay, so on top of a shaky global economy and a war scare, the third storm was brewing right inside the crypto market itself. This was an internal meltdown, and it was fueled by the market's own mechanics. And to really get this part, you have to understand one crucial word: leverage. Let's make it simple. It's just trading with borrowed money. Now, it's a tool that can massively amplify your gains, but, and this is a big but, it can also amplify your losses just as quickly. And this is the result. As prices started to fall, traders who had used all that leverage got hit with margin calls. That forces their positions to be sold automatically. In one absolutely brutal 24-hour period, a staggering $2.5 billion worth of positions were liquidated. Yeah, this wasn't just a one-time event. It created this vicious, cascading cycle. Each wave of liquidations pushed prices even lower, which in turn triggered the next wave of forced selling. It was a domino effect that put the crash into overdrive. And you can see here how a major engine of the bull market just suddenly slammed into reverse. The spot Bitcoin ETFs, which had seen these massive inflows of cash, suddenly saw huge outflows. We're talking over $1.6 billion in January alone, and that just added immense selling pressure to an already panicked market. Another internal risk came from a place nobody really expected. During the bull run, you had all these large corporations buying Bitcoin for their treasuries, right? And it was seen as this amazing sign of mass adoption. But during the crash, these massive, concentrated holdings, they became a source of fear. This slide just makes the problem crystal clear. Look at Strategy Inc., the largest corporate holder of Bitcoin. They had an average cost of around $76,000 per coin. Well, when the price dropped below that level, their entire multi-billion-dollar position was suddenly underwater, and that just sparked fears that they might be forced to sell. So, after that perfect storm of macro pressures, geopolitical shocks, and these internal meltdowns, where does the market stand? Let's try to put this whole thing into a bit of historical context. As painful as this crash was, these devastating bear markets, or crypto winters, are actually a recurring feature of this industry. We saw it in 2018 after the ICO bubble burst. We saw it again in 2022 with the collapse of Terra Luna and FTX. This latest crash is really just the next chapter in a highly cyclical story. Which leaves us with the crucial question, right? Is the 2026 crash just another brutal but predictable crypto winter that will eventually thaw out? Or have these new factors like institutional ETFs and these deep ties to the broader economy, have they fundamentally changed the climate for good? That right there is the billion-dollar question.